For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for more updates.
Did you know that the Indian arm of several multinational companies outperformed the parent? Did you know that India is projected to become the second largest consumer economy in the world? Hello and welcome to another edition of Capital Calculus. I'm your host, Anil Padmanabhan. Recently, the Harvard Business Review published a paper co-authored by 3 professors. It had a very simple proposition to MNCs or multinational companies. It asked them whether they had an India strategy, and if they did, how were they adapting it to local conditions. This is a fascinating pivot. Moving away from merely waxing eloquent about India's potential, they are actually asking the MNCs to walk the talk. An India shining moment for MNCs, as it were. To unpack this proposition, we spoke to one of the co-authors, Professor Anup Srivastava. He's a professor at the University of Calgary. I began by asking Anup about the central thesis of the paper published in the Harvard Business Review.
So it is the fastest growing market. It is the largest market. And I think we do lots of analysis. And based on data, it is the emerging as the most promising and the biggest market. So any B2C company around the world, if it doesn't target the fastest growing market and the largest market in the world, and it's the best market opportunity that the world has seen for a long, long time, then obviously its strategy is not working. Put it bluntly, if you don't have an India strategy and you're a B2C company, then you don't have a strategy at all.
So Anup, how much of is it due to what India is showcasing to the world, and it is about the rest of the world not, facing a very inclement time, as it were?
It's both the factors. India's time has come. By sheer numbers, you're talking about 1.4 billion people. A 10% population moving into middle class. It's 140 million people. That's half of EU's population. So the sheer numbers, and when you compound them for a long period of time, 10 years, 15 years, 20 years, it adds up to a large number. India's population is twice that of US and EU combined. We're not talking about an individual country here. US and EU combined, multiplied by 2, and that's India's population. So small changes, percentage changes in that huge base, compounded over a long period of time, it's a huge opportunity. That's the first factor. On the other side, we see dwindling populations and we see aging populations in the so-called developed countries. So you have a negative aspect in certain countries with certain level of base, and you have a positive aspect in another country with a huge base. Obviously, the opportunities that we're talking about are, there's like a chasm between these two opportunities. They're not even comparable.
So Anup, effectively what you're saying is that India is emerging as probably the world's biggest consumer market.
It's not there yet, and it will take some time. China remains the world's largest consumer market and will remain so for quite some time. But when you talk about deltas, you talk about changes. That's huge in India. When any company plans a strategy, it just doesn't look at its level today. It looks at changes, expected changes. And those numbers, just to give you one fact, in purchasing power parity terms, India is already a whole of EU together. So we're not talking about France or Germany or any other country individually. We're talking about whole of EU put together. And by 2030, we would have already surpassed it in PPP terms. In raw numbers, we will be twice that of EU. So the deltas, the changes. Now you look at China, it's dwindling. It is the largest market in the world. There's no doubt about it. But it's dwindling and it's aging population because of single child policy. So it is emerging as, again, I will say, the most attractive opportunity. Attractiveness comes both from current base as well as the growth opportunities, and India offers both.
So, Anup, one metric that your paper used was the price to books ratio. So, can you explain to our viewers, probably some of them like me do not understand the metrics of the market? So, very pithily, you're a professor, so if you could lay it out for us.
So yeah, I'm also a finance professor. So let me explain what price to book ratio is. Let's say you buy a car for $100. That's your book value. The question is, what is the price of that asset that an investor would be willing to pay? An investor would be willing to pay a price for that car based on its cash flow potential. What kind of cash flows, what kind of profits it will produce from today all the way into future. So price for a company represents not the value of its assets as historical cost, but what is the present value of profits that you can get. And present value of profits that you can get is a function of three things. First, how profitably you utilize the asset to produce profits. That's today. At what rate will the profits grow? And the third is, what is your cost of capital? The discount rate, because we're talking future cash flows. It's a function again of three things. How profitably you utilize your assets to produce profits. How fast will the profits grow all the way into future? And the third is, what is the discount rate? And what we claim is that price to book ratio for multinationals in India is significantly higher. We offer umpteen number of examples to show that it's, several times higher in India than in their own home countries.
Thank you for explaining it so simply, but it is a little counterintuitive, given the various handicaps that come with India, logistics, administrative issues, all these things, and you still say that the domestic arm of these global MNCs are outperforming their parents. Can you explain why?
So again, let's talk intuitively. We all invest based on return on investment. All else equal, you'll invest in the bank. You'll put your money in a bank which gives you higher interest. All else equal. So return on assets is broad profits you get from your initial investments. And profits is again a function of two factors. First is, let's say you buy a car, $100. What revenue can you produce from that car? So how well you utilize your asset to produce revenues? And the second question is, how efficiently you run that car to produce profits. So first asset base into revenues, and revenues into profits. And surprisingly, on both aspects, the multinational subsidiaries in India have better asset turnover and better profit margins than invest. Now, the counterintuitive part is that you will say that India has logistics issues, it has infrastructure issues, it has bureaucratic hassles. So how come it has higher profit turnover? But maybe it's our mentality that we know how to utilize assets much better than people do. So that's the asset turnover part. The second is, it's the multinational products which have to be priced cheaper in India, given our lower purchasing power parity. We have lesser purchasing power. So they're discounted in terms of selling price, but the profit margins are higher. So how is it possible that selling price is lower, but profit margin is higher? That means that our cost of production and the distribution costs are lower than invest. So counterintuitively, despite all the negative things we hear about India, the asset turnover of multinationals in India is better. The profit margin in India is better. So these two factors combined lead to higher return on investment, which is, sounds counterintuitive.
So, Anu, very interesting. So far, you have, two very key takeaways I have. One is India is leveraging the power of its population in terms of creating a potential market. Secondly, you're saying that its culture of jugaad, because it emerged in a context of scarcity, is actually coming to its advantage today. But you don't fear that there'll be compromise on quality, etc. While profits may be up, but quality may be an issue.
So, India has its own issues, when we say quality, that can mean product quality, it can mean quality of service. And, for example, if previously you ordered 100 shirts from India, 100 shirts meant 100 shirts, but in India, it could mean anywhere from 90 to 110. And if you ordered it on 20th of December for Christmas sale, it could reach anywhere from 30th of November to all the way going up to January. So, but we know that the quality of service has improved. I am a trends person. I don't look at levels. I look at how things have changed. Quality of service has improved. Product services have improved. I travel to India once every year, and we know, how our planes used to operate. Today, if there's a 10 minutes delay, they announce it. I live in West. I live in Canada. 1 hour delay is like normal. So things have changed. Yes, in several respects, we are nowhere close to where West is. But if you look at the percentage change, that is dramatically positive. That's the first thing I will say. The second thing I will say is ultimately we are finance people. We care about if we spend $100 today, what is the return on investment and what is the rate of growth? In those respects, India is far ahead. We have given umpteen number of examples where all else is equal. It's your own product in your home market and it's your own product in India. You have better return on investment, you have faster growth rate, which translates into better price to book ratio.
So interesting, Anup, when you are outside looking in, you believe that India has probably crossed the tipping point where, it's moving out of a past which there are a lot of negatives about it and is increasingly more positive aspects about it that are emerging, right?
Yeah, I will say that a lot of things have come together. Let me give you a totally different example, which has got nothing to do with India. India has been sending talent to West for a long time. People have been leaving 50s, 60s, 70s, 80s, 90s. I'm a 1988 IIT Delhi batch, and half of the batch will just leave India. So India has been exporting talent. There's no reason to believe that the talent that is coming out today is far superior than talent that came out in 60s or 90s. But today we have Indians who are heading the tech corporations, the world's largest. So how come that things have happened today? It's all a factor of many things coming together. It's a function of establishing reputation. It's a factor of establishing expertise. So similarly, a lot of things have come together in India. And, people forget the power of compounding. If you increase something at 3 to 4 to 5% a year, or in India's case, it is 6% a year in real terms, and you compound it over 10 or 15 years, it is not 10 times 6. It's not 60%. It could be more than 100%. And that dramatic change with this huge base, all of those factors coming together, India's democratic society, India's way of functioning, India's, you can do business in India, nobody's coming to, the things that we have seen in China don't happen in India. So a lot of factors have come together. Attractiveness of market, ease of doing business, improving infrastructure, trained manpower, lower cost of production, a lower logistics cost, innovation. Those factors have come together and created this huge market potential.
According to Anup, if MNCs need to succeed in India, they have to follow one mantra: go local.
Well, you enter a new market, you have to create your strategy tuned to the new market. And it's no longer transplanting, you have a Gillette, a razor blade that sells at certain prices in West, and you launch that in India, let's say 20% cheaper. It's not going to work. First of all, the given purchasing power in India, you have to price it lower. But that's the negative side. On the positive side, if you want to make money, you have to produce it in India. You have to use Indian source raw material. You have to use Indian talent to build factories, and you have to use Indian workers, and you have to transport it using India's transportation model. Good news is it all comes at much cheaper cost. So that's on the cost side. The second thing is India is its own peculiarities. We all understand that we have certain cultural norms. We have certain, multiple languages. We have our distributional challenges. We have lack of heating. It's sachetization of products. Shampoo selling for one sachet, or cigarette selling for one cigarette piece. There are certain peculiarities. If you want to address a market, you cannot say, okay, this is the way things sell in West. This is the way we sell shampoo, and we are going to use the same strategy here. one has to start from scratch. One has to go back to drawing board. The good news is, if you do it, like umpteen number of multinational examples that we have given, you will do it at much higher profitability here than you're doing in your home country.
But India in the past has only flattered to disappoint.
I think the underlying movement is solid. I focus on the underlying market, the growth potential. There is nobody who can stop the train that is running right now. Yes, in past, you're talking about 2000s. I'm an old timer. I go back to much longer. I'm talking about, we imposed emergency. We have had time when multinationals were thrown out, Coca-Cola and IBM was thrown out. Things have happened. All I'm saying is the likelihood of those things happening now are much lower, simply because people are more aware. The base is strong, and it's no longer that the fact that it can be simply imposed. India is not China. India is a democratic country. So voices cannot be totally suppressed, and the people are more aware. The youth is more aware. Thanks to this internet connectivity, they are aware of how things happen in West. When I was born and brought up in a small town in India, I was not aware of the lifestyle. Today, a person who has never stepped out of the country is aware of freedom, is aware of voicing their concerns, and it's in a different situation compared to where it was in 60s or 70s. So, I think to summarize that part, the base is so solid, and it's moving at such a steady pace, and there's momentum. It's not that it's a 1 or 2 year old story. This is a 10, 15, 30-year story in making. It's moving at such solid pace that unless there is a catastrophic event, the bad events are unlikely to happen. Of course, there will be hiccups here or there. That's a part of any society.
You heard Anup. His proposition is very simple. India's moment is the right, and if MNCs are not to miss this party, then they need to act now, talk local. They're looking for proof. All they need to do is review the operations of their India arms, which is outperforming the parent. Indeed, this is an India shining moment for MNCs, as it were. Thank you for watching. If you liked the episode, do hit the like button. And please to subscribe to StratNewsGlobal on YouTube. Hit the bell icon so that you don't miss any updates. And please to share your thoughts, ideas and suggestions with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.